Welcome to the deep dive. We're jumping straight into the Q3 FY 2025 earnings call materials for Third Bancorp. That's FITB.
Exactly. Our mission today is to pull out those key financial numbers, understand where management sees things going, and really synthesize the big strategic plays for you.
Okay, let's get right into the financials then, because, well, the headline numbers looked pretty solid, didn't they? Adjusted EPS was 93 cents.
Yeah, beat the consensus of 0.86 cents, and revenue was strong too. $2.31 billion, that's up 8% year over year, also beating estimates.
That revenue growth is good, but you often say we need to look deeper, right, at core profitability.
Absolutely. Net income available to common shareholders, that was up 14% year over year, $608 million. But the number that really caught my eye was the adjusted pre-provision net revenue, PPNR.
Okay, tell us about that. Why PPNR?
Well, it grew 11% year over year. Now, that's actually Fifth Third's highest annual growth rate in, I think, over 2 years. PPNR growth, is sort of the purest measure of how the core bank operations are doing before you account for credit losses.
So it shows underlying strength.
Exactly. It tells you their basic profitability engine is firing well. And it's not just, say, riding a temporary interest rate wave. And honestly, this strength is what allowed them to handle that big credit issue we'll get to later.
Right. Okay. And looking at how they make money, net interest income, NII, was up too.
Yep. NII rose 7% year over year, came in at $1.525 billion. But the really impressive part is the margin.
The net interest margin, NIM?
Yes, the NII, it expanded again. This is the 7th consecutive quarter they've managed to do that. Landed at 3.13%.
Seventh quarter. Wow. Given the pressures elsewhere, that's quite a streak.
It really is. For anyone tracking banks, NIM compression has been the big headwind. So maintaining expansion like this, it shows they're, actively managing their funding costs and asset yields pretty effectively. They're definitely ducking the trend there.
And it wasn't just income. Seems like they were disciplined on costs, too. Positive operating leverage again.
4th consecutive quarter of positive operating leverage, yes. And you saw that in the efficiency ratio. It improved, 180 basis points year over year, down to 54.1%.
So how'd they do that? Just cutting costs everywhere? Or was it revenue outpacing expenses?
It seems more like revenue scaling. Management actually pointed out they achieved this despite making significant investments, in tech and branches. So it suggests revenue growth is simply running faster than expense growth. That's healthy.
Okay. And those tech investments, are they starting to pay off in efficiency?
They indicated that, yeah. Things like digital customer experience, process automation, those are apparently starting to deliver measurable cost benefits now, feeding into that better ratio.
Got it. Quick word on capital before the outlook. Tangible book value looked good. CET1 ratio on target.
Yep. Tangible book value per share grew 7% year over year. CET1 ended right at their target, 10.54%. And, early in the quarter, they bought back $300 million in stock, raised the dividend 8%. All signs of confidence, right?
Seems like it. But you mentioned holding that thought on capital returns.
Right, because things shift a bit when we look at the guidance and the strategy around the big acquisition.
Okay, let's pivot then. Management's view ahead. What are they guiding for Q4?
So for Q4, they expect NII to be stable to maybe up 1% compared to Q3. But here's the interesting part, the assumption underneath that.
Oh, what's the assumption?
They've explicitly built in 2 25 basis point rate cuts from the Fed during the fourth quarter.
2 cuts. Wow. Okay, so they're positioning for easing. What if that doesn't happen?
Well, then you might see some upside pressure on that NII number, or at least it stays stable. It's a key dependency to watch.
Definitely. And loan growth for Q4.
They're expecting average total loans up about 1% sequentially. They mentioned seasonal factors, but also strong C&I pipelines and continued consumer lending momentum. So steady growth, not spectacular, but solid.
And on the fee side, non-interest income.
Projected up 2 to 3%, mostly driven by seasonal strength they expect in capital markets, plus ongoing growth in commercial payments.
Makes sense. And to fund all this, expenses.
Guided up about 2%. They tied that directly to those ongoing investments in branches and their tech platforms. Growth costs money.
Right. And looking out for the full year, did they stick to their main commitments?
Yes, they reaffirmed 2 big ones. First, delivering a record NII for the full fiscal year. Second, achieving 150 to 200 basis points of positive operating leverage for the year.
Hitting both would be quite something in this environment. Shows confidence.
High confidence, absolutely. But then comes the twist on capital returns we hinted at.
Ah, yes, the share buybacks. They're pausing them. That's a big shift from the Q3 repurchases.
A very significant shift. They announced they are pausing all share repurchases starting now, until the Comerica acquisition closes, and that's not expected until late 2026.
Late 2026. So a long pause. What's the trade-off they're making there?
It's basically growth and integration readiness over immediate shareholder returns via buybacks. They're conserving capital, keeping their powder dry to ensure they have maximum strength and flexibility for that massive Comerica deal and the integration effort that follows. It's a clear prioritization.
That really sets the stage for the strategy discussion. Let's tackle that big credit item first, the tricolor charge. That seemed to loom large over the quarter.
Oh, absolutely. It was a major event, a $178 million provision expense, specifically tied to fraud related to the bankruptcy of an auto dealer, Tricolor Holdings. And this one item really inflated their net charge-off ratio, the NCO ratio.
Pushed it up to 1.09%, right. So how did they convince investors this wasn't the start of a bigger credit problem?
They were very clear in framing it as isolated. The narrative was less about general economic stress hitting borrowers and more about a specific breakdown in controls related to managing their exposure to this one single subprime auto vendor.
So if you strip that out,
if you exclude the tricolor impact, the underlying NCO ratio was actually 0.52%, much more in line with recent trends, much more manageable. And they back this up by pointing out that commercial non-performing assets actually declined 14% sequentially. Lowest level in over 3 years, actually.
okay, so the underlying book looks stable, maybe even improving on the commercial side, and they expect NCOs to drop sharply next quarter.
That's the forecast. They expect Q4 net charge-offs to fall back down to around the 40 basis point level. That projection really signals their belief that the Q3 charge was a one-off cleanup. They took the hit to clear the decks, basically.
All right, credit stabilized, seemingly. Let's talk long-term capital deployment. The Comerica merger, still on track for late 2026. Management called it better, not just bigger.
Still on track, yes. And that better, not just bigger line, it boiled down to a few things. Improving their funding base, getting in more high-growth markets, and boosting their fee income streams. Post-merger, they'll be in 17 of the fastest-growing large metro areas in the U.S. It's about scale, yes, but scale in the right places.
You mentioned a specific funding benefit related to the Direct Express program. Explain that for us. What's the significance of those deposits?
Right, the Direct Express program. Comerica currently handles distributing government benefits to about 3.4 million people through this program. That represents around $3.5 billion in demand deposit accounts, or DDA.
DDA is good because
It's typically very low cost, sometimes zero cost, and it's incredibly sticky. People use these accounts for daily transactions. It's not hot money chasing yield. So when Fifth Third merges with Comerica, they inherit this program and those billions in stable, cheap funding. It's a huge boost to their deposit-based quality and helps support that NII we talked about earlier.
okay, that makes sense. A big, stable funding source locked in. But even with this huge merger on the horizon, they're still pushing organic growth, particularly in the Southeast.
Oh yeah, full steam ahead there. It's not like they've paused everything else. They opened 13 new branches in the Southeast just in Q3, including their very first one in Alabama, and they plan another 27 by year end.
That's aggressive expansion. Is it working? Are they actually gathering customers and deposits?
The numbers suggest yes, quite successfully. Consumer households for them in the Southeast grew 7% year over year. That's apparently more than 4 times the underlying market growth rate in those areas.
4 times. Okay, so their new branches are hitting the mark.
It seems so. They even shared some metrics. Branches opened in just the last couple of years are beating their internal targets. They're hitting over $25 million in deposits per branch by month 12 on average. And importantly, their cost of deposits in the Southeast is really low, under 2%. So they're attracting quality, low-cost funding organically, too.
All right, let's try to pull this all together. We've got strong core profit growth, that NIM streak, but also a big one-off credit charge. Then there's the huge Comerica deal looming, the buyback pause, and this continued aggressive organic expansion. What's the synthesized picture for you, the listener?
I think the picture is one of, let's call it managed complexity. They showed real financial resilience this quarter, strong PP&R, expanding margins, which gave them the capacity to absorb that tricolor hit without derailing everything. At the same time, they're clearly juggling multiple major strategic initiatives, preparing for Comerica, while still investing heavily in organic growth like the Southeast build-out. It's proactive, definitely not just reacting.
And it all comes back to that mantra the CEO repeated, right? Stability, profitability, and growth in that order.
Precisely. Stability first. The numbers, even with the tricolor charge, seem to support that they're sticking to that playbook.
So a comprehensive deep dive into Fifth Third's Q3 2025. We covered the EPS beat, that impressive 7-quarter NIM run, the strategic pause on buybacks for Comerica, and the ongoing push into the Southeast.
And maybe the question for you to think about moving forward is this. They're committed to record NII this year. They plan to open 60 more branches next year, all while prepping for the massive Comerica integration and keeping buybacks paused until late 2026. How difficult will it be to truly maintain that stability, profitability, growth order under those conditions? That's a lot of balls to keep in the air, especially balancing major investments against near-term capital return constraints. It's a significant strategic test over the next couple of years.
A very interesting question indeed, something for everyone to consider. Thanks for joining us for this deep dive. We'll catch you next time.